Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Here's Attorney-CPA Joe Cordell.
Welcome to another episode of ElderTalk. As we've been trying to do here, Jill, over the last, 6 weeks since this coronavirus thing started?
My goodness, yes. Back in March.
So we're trying to focus on what we know you're focusing on, which are things related to this virus. And so we've had guests to talk about health matters. We've had guests to talk about lifestyle during this period of time. And so today we wanted to have a guest incidentally that has been very popular with you in the past, but a guest to talk about the financial impact of this and what we should be doing from a financial standpoint. We've done this a little bit before, but Todd Edkin with Baird has been on, at least 2 times in the past, maybe 3.
Right, back in November.
And was one of our most popular guests. So he's with Baird, and he's a financial planner. He's a financial advisor. He's a certified financial planner, which is CFP. So he dedicates his practice with Baird, which is a national organization in terms of financial management, money management, et cetera. He focuses his attention to a clientele that is pretty much 65 and older. Is that safe to say, Todd?
Yeah, a lot of our clients are a little bit older like that.
Well, so with clients, though, who are in the circumstances of many of you listening. So, Todd, welcome back to the show. We're glad you could work this into your schedule, and we can talk about some of these issues.
I appreciate the opportunity, and this time we're working from home, so it's kind of a new era for us here.
Yeah, so tell me what you've been hearing from your clients over the past month or so. What has been their primary concern?
We've been very fortunate, I have to admit. Most of our clients are somewhat seasoned investors, and, I probably make 30 calls a day. Because, the biggest thing to do in crisis is to make sure you can communicate with the people that you're working for. So we have reached out to every one of our clients a couple times already. And, we just want to make sure that when we're talking to them that, find out what their concerns are, which have been pretty much minor in the fact that I think the reason for that, much more than 2008, is because most of them, or all of them really, understand it's a national problem. It isn't something that the financial markets created. It's something that is out of our hands and out of our clients' hands, and they've kind of just accepted it. So our conversations are more about what do we need to do for you in the short run to make sure you're covered, and then we'll worry about the long run after that.
But what about the impact on lifestyle? Let's assume that this decline in the market, which there has been a rally, some call it a bear rally, that the market will ultimately go further down. And those clients, though, are looking at a very real reduction in monthly income, aren't they, if they're relying on these dividends or interest in the case of bonds to sustain their lifestyle?
Yeah. I guess you have 2 different type of investors there. You have the one who is retired and living on the income from their portfolio and Social Security or pensions. So, the Social Security and pensions don't seem to be going away. So the other portion is how much are they taking out of their portfolio? We've made a conscious effort over the years of making sure our clients have at least a year of cash in their portfolio. So when we have a big downturn in a market like this, we don't have to sell a depressed asset in order to generate income for them. We take it out of the cash. And as the market rebounds, we'll replenish that cash. So the biggest conversation piece has been, hey, has your needs changed any? Which most of them are saying that their actually expenses have gone down since they're not going out to eat and doing those things they were doing. And then just making sure there's enough cash and 2, reassuring them that 15 months, 12 months, 15 months, 18 months from now, we'll recover and things will get back to normal, hopefully. So what do we need to do in that short-term period? And that's where the discussion is that part of it.
So what are the Baird analysts saying then, the analysts that you guys have in Wall Street and whatnot? Are they predicting that this is going to result in a recession that may extend for a year or longer? What are their forecasts?
Yeah. I don't think any of our analysts that I've read, or even any other people analysts, are really predicting a period of time. Most of the ones we listen to are saying a lot of it depends on when and if the pandemic can kind of we can get a handle on it. Is there a vaccine? Is there some type of drug that kind of can prevent it or help it in the near term? And if that happens shortly, or at least the word of that happens shortly, then it'll be very short-lived, and hopefully we'll get the economy running back in the fourth quarter. If it doesn't, then it might go out 12 to 15 months. It's kind of what most people that I've talked to are thinking.
So, Todd, you do seem like you're pretty secure about us rebounding, but what was your reaction when COVID-19 was first declared a pandemic? Were you, I'm sure concerned, but were you panicked?
I'm an optimist, Jill. I don't really panic. And again, the reason I don't panic for my clients is because going into this, we've already discussed what their risk tolerance are and kind of explain, hey, in 2008, if this would have happened, what would you have done? And if they said, hey, I really would have panicked, then we wouldn't have had them all in stocks. We would have had some in bonds and some in cash. And so hopefully, when these things do happen, we've got the portfolio already kind of set up to their risk tolerance. Now, I have to admit, with this one, we went down so fast and so in such a short period of time that it made me go back, and when I'm talking to my clients, ask those questions again. How is it making you feel? Are you being able to sleep? Because that way, when we do come out of it, I need to adjust their portfolio if this is making a huge emotional impact on them. But so far, gosh, these conversations I'm having with my clients are more very social aspect of it. How are things going? They're telling me about their kids. They're really, there's a little bit about their portfolio, but it hasn't really been tremendous. I hate to say that because that's what I do.
But Todd, surely you've had clients who called you when the stock market plunged from the Dow went from 30,000 to 19,000. Surely you had some calls in which they said, "Get me out."
Yeah.
Did you try to talk them down from that, or did you just find that your clients were going to want to bail and that you were just discharging those orders?
Yeah.
How'd you deal with that?
Yeah, I would not be doing my job if I just took their word and said, hey, let's go with that because that's a good idea, because it's not a good idea. So those conversations, and we've had them, there's not been a lot, but there's probably been maybe 15, I would say. And during that conversation, the first question is, why do you need to get out? Do you need the money right now? And then we kind of go through what their needs are and why they're panicking about that. And then what we try to do is hit a happy median where we get enough out to support them for that length of time that they think they need the help, and we leave the rest in to grow. But if they're adamant about it, we have had, some clients who have gotten all the way out of the market. The problem with getting all the way out of the market is no one can time the market to get back in. So by the time we've made the decision to get back in, we've already probably lost 15 to 20% uptick in the market.
So that's something you obviously recommend against.
Yes, we recommend, again, making sure that your portfolio is situated where you can weather these downturns without having to sell a depressed asset.
Now, Todd, what about your clients that are pre-retirement age and they may have lost their job, laid off because of this pandemic, and there's this temptation to dip into their retirement accounts? What are you telling those people?
Especially given that they can do that now to some extent without penalty, right? For purpose,
that's correct.
Yeah, for some expenses.
Yeah. Up to $100,000. And used to be when it was a lot less than that. So, well, the first thing I talk to them about, and again, I've had those conversations, is, what are their expenses and what can they cut out? Talk more about a budget to weather the storm before you do that. Because if you take the money out of that is the worst place to get it from. Not only if you need $2, you got to take out $2.50 in order to get the $2 because you still have to pay the tax. You may not have to pay the penalty, but you still have to pay the tax.
Yeah.
So it's just not the best place to take the money from.
And losing that opportunity for it to compound over time tax-free is a huge future value cost.
But now there's some people who are in a position where they don't have any other options. And if that's the case, we try to make it as minimal as possible to help them through that.
Yeah.
The other thing we talk about is, watch their credit cards, because in the short run, you don't realize this might last 6 months or 8 months or 9 months, and unemployment might run out and you may not have that job back yet. But it's easy right now to get on Amazon. Amazon's one of the biggest money makers out there today because people are at home just clicking on buttons and it goes on that credit card and you don't see it till the end of the month. Then all of a sudden you have a $5,000 credit card bill and you have no way of repaying that.
Yeah, I think a lot of people probably, there is that temptation to overspend because they're at home, they're bored.
Right.
I was talking to my neighbor the other day, and he was saying that he and his wife have been spending money like crazy because they're bored.
Yeah, in other words, it's not lifestyle expense. It's sitting at home. It's just like you're eating more. So
Yes.
I guarantee you that there's been an average increase of weight across America through this period of time. But also, I think a lot of people are sitting home on their screens, and it's so handy to just go to a website and amuse yourself and order stuff.
Mm-hmm.
Yeah, I think people have to be careful because you have to look down the road and where is my if I'm not working, where is my income coming from?
America has never gone through anything quite like this. There's no real analogy. Maybe even the Spanish flu, it was left almost entirely to states. Trump is getting some criticism because he is leaving a lot of discretion to states. But the Spanish flu remember, at the time, the federal government wasn't even perceived to have the constitutional authority to intervene in other states. So it was just taken for granted that every state's kind of on their own. And so a lot of different policies were followed in different states. But in terms of uniformly shutting down a nation, there's just no precedent for this in human history.
There's not, and we can't continue like this. There's inherent risk in everything you do. And what happens is people get used to the risk, and then they're willing to go out and accept those risks. Be it riding a motorcycle, smoking cigarettes, taking drugs, whatever those risks are, cancers. If it's prevalent in the society, you eventually just accept it. Now this is completely different, but eventually we're going to have to somehow or other get this economy back together because people can't stay home because, the ones have saved are fine. They can stay home and support themselves. But some people are living paycheck to paycheck. Once unemployment is over, they've got to be able to feed themselves somehow or other.
Yeah, and there's been a lot of protest across the country. I just saw the other day in Oregon where about 1,000 protesters demonstrated outside of the Capitol there, saying reopen Oregon. And I believe their numbers are similar to the cases we have here in Missouri. And there are some businesses there in the Portland area that have decided to reopen, and go against the governor's orders there.
Yeah, Portland's one of those strange towns, a little like Austin, Texas. You can't predict what they're going to do, but there is a lot of unrest, and California is another good example.
Sure.
Right.
So it does make me wonder, though, whether it's realistic to think that when you lift this order after this financial devastation to certain industries in particular, but major industries such as hospitality and airlines and other things relating to travel, et cetera, that there would be anything resembling a V-shaped recovery, that instead we have to just assume that we're going to have a recession, maybe not a depression, but a recession for the balance of this year. Don't you think that's realistic?
I agree. And, my family's in the hotel business, and we have 3 hotels, and one is 1,300 rooms, one's 600 rooms, and the other one's right at 400 rooms. And we've laid off 700 people. And, when we look down the road and we're thinking, number one, an issue we have is that a lot of our employees were, housekeepers and kind of entry-level employees, and they make more money staying home right now than they do coming to work because they get the $600 stimulus plus whatever their unemployment would be. And we support them. We want them to collect that, but they make more money probably staying home. So if it came back really quickly, let's say they turned off and all of a sudden 1,000 people were staying in the hotel, we wouldn't have the employees in order to take care of that. And secondly, we look at how long is it going to take, even if you lift all the bans, how long is it going to take to change the psyche of the individuals to say, I don't mind being in this crowd to come to a hotel that really is based on conventions. So, we're looking more like 8 or 9 months down the road to say maybe we'll slowly start trickling back in.
Yeah, and there's not going to be a government stimulus to get, I don't think, hotel industry, et cetera, by for that period of time. I think that this generosity that has resulted in trillions of dollars being injected into the economy between the Fed and the fiscal stimulus.
Right.
I just think that the appetite for that, or at least the political support for that, is probably going to evaporate in the next month and a half to 2 months potentially.
I agree. And then you're on your own. So if you're over leveraged, you're probably not going to make it back on the market. And, we've been looking at that too, and see if it's an opportunity to buy properties down the road. There's always going to be a buyer for you. It's just the original owner is not going to make it. And we may be one of those original owners. Who knows? It depends on how long it takes. But, that's just part of the economy. And, United States economy is it's supply and demand and who's the strongest, and they're the ones that seem to survive.
And I think it's interesting what you brought up about changing the psyche, because I do think there's a lot of fear out there, and this will hurt many industries because you think of, say, concert halls. People still have that fear, and even if there is a vaccine, will they still go to those venues?
The idea of sitting that close now seems claustrophobic. Because now, even in a movie theater, you think about that industry, that which may have been changed forever. Apparently, some of the large production organizations, which includes things like Netflix now is doing its own productions, Apple's doing its own. You have Disney Plus, and then of course the traditional studios in Hollywood. They're going to do initial. What's the initial premiere of a movie? I guess you call it premiere. The premiere of new releases. Apparently, they're going to stream it at home on people's screens at home, whether it's television or whatever it might be.
Yeah.
And that concerns me. It's changing the way we did live, and you don't want to see people being afraid to go to a movie theater or a concert or a ball game. I mean, at some point we have to say, okay, it's safe to go out there.
Yeah.
I think we will. I think we'll get there, though. I just think it's going to take, 8 months or 9 months or whatever it might be. But I think the American people have a short memory on catastrophe kind of things like that.
Buffett. He was which Buffett?
Warren?
It was Warren. Yeah.
Yeah.
Jimmy Buffett. Wonder what he's doing these days. He's still living.
He had a lot of wisdom too, though.
Anyway. So, Warren Buffett was giving some very encouraging remarks at his annual event that he holds in Omaha each year. And he was saying that he felt a high degree of optimism for the economy. Some have suggested that the market moved favorably on Monday of this week as a result of those remarks. But he did say that he's sitting on a lot of cash. He thinks opportunities will be available through this for people who do have the cash, as you were suggesting. Are you similarly telling some of your people who already have cash that maybe now's not the time to run in and buy even in the market?
Well, we were buying 4 weeks ago. When we had the big downturn, we bought some.
At its bottom.
At its bottom, we bought some, and then we've kind of waited thinking there was going to be a pullback. But the longer it goes, it doesn't look like we're going to be testing those lows again. But so we bought a little bit more. People have cash. Sometimes it's easier if they say, hey, just buy on this day every month for the next 3 months. That way you don't have to time it. It seems to work out probably in the long run, works out that way too. But yeah, if people had cash, it was a good opportunity to buy. The other thing, which is a great opportunity for some people, wealthy people, is to get some money out of their IRAs and convert it to a Roth IRA.
Yeah.
Some of them that have, a couple $1 million in an IRA, you would think with all the stimulus and with all the debt, they're going to have to raise rates. And if that's the case, when these people turn 72, they're going to have to start taking money out of those IRAs and their taxes are going to be higher. And now we're in a very relatively low income tax bracket. So we've converted some IRAs to Roth IRAs and, let the people, the ones that had the cash to pay the taxes and do that. And we got some of their money out a lot cheaper than we could have 6 months ago.
And can you explain the difference between an IRA and a Roth IRA?
So an IRA, you do not pay taxes on it when it goes in. So it decreases your taxable income when you put money in it. So as you get older and you start using money out of it, then you have to pay ordinary income tax on any monies you take out of there. And the government does tell you at 72, it used to be 70 and a half, they've changed it to age 72, that you have to take so much out per year and you have to pay taxes on it. Well, a Roth IRA, when you can fund it yourself, but most people in our categories might make too much money where they can't fund it because they get phased out. But if you put money in, you put in after-tax money. So when you take it out down the road, number one, there's not a required minimum distribution, so you can leave it in there until you pass away. And secondly, when you take it out, there's no tax on it because you've already paid the tax. So you get that growth comes out tax-free. So for some people, it makes a lot of sense to get it out of their IRA when you have a down market like this, then not.
So tell me, though, Todd, is that also an opportunity for those with 401ks? Because I know that many of the people who have large tax-deferred accounts, it's through their employers and 401k, and unless there's some counterpart through their employer, they don't have that opportunity, do they?
They don't. It's not allowed in a 401k plan. You'd have to have a 401k plan that would allow you to take an in-service withdrawal, and you could roll it to an IRA and then do it. But we've kind of almost missed the mark where it makes sense to do that now. We're up 20% from the low. So, we did that at the very beginning of this because we had a big discount in the market. Mm-hmm. That opportunity might be, but it still might be an opportunity because, again, I truly believe we're not going to keep these low income tax for too much longer.
I think that's the real incentive is for people to recognize that rates will go up. I'm like you, Todd. I'm just confident that rates are going to have to go up in the next 3 to 4 years, if not sooner. So why not go ahead and take advantage of paying the tax now? Right. And get it out of the way.
Right.
And if you just think about the poor pension funds in these states, they were already depressed and they were already endangered. And then you have a market like this and you still have a big portion of their fundees that are already retired that are still taking money out of that pension fund. So they don't have that ability to let it stay in there and grow. So you would think down the road that these different states are going to have to raise taxes just to fund the pension funds.
And if you're just tuning in, we have financial advisor Todd Edkin with us today. He's been a guest in the past, and he's back by popular demand.
Yes, CFP. He's with Baird. Many people are familiar with that, a national financial management firm. And we wanted to talk to Todd about the things that people confront in the midst of this coronavirus crisis. And no question that among the things that people think a lot about, probably second only to their health during this period of time, is their financial circumstances. So why don't let's take a second and talk about some of the categories of investments that you tend to feel more confident about in the long term. Whenever people decide that they want to invest in the market, some may have pulled out and they're thinking about sticking their toe back in. Make some comments about some broad categories, like, for example, ETFs and those that are focusing on certain sectors. Do you have any opinions maybe that Baird has expressed regarding sectors? And are there any alternative investments. And can you make a comment about bonds? Are bonds generally something that you think is a good idea now or not? I've thrown a lot at you there, but I want to get kind of your general approach to investment.
Yeah. Well, let's start with bonds. That's kind of an easy one. So with the Fed lowering the interest rates, bond interest rates are at rock bottoms. There's just not a lot of yield, meaning that they won't pay that much if you invest in them. So, it is safe if you buy the right kind of bonds, meaning if you buy a U.S. Treasury or if you buy a really good large company bond, maybe. But
Are there ETFs that focus on bonds?
They do.
Okay.
They do have ETFs that do bonds too. But the difference is if you buy a bond, an outright bond, you're lending, let's say, $1,000 to this company. And the company is going to say, hey, I'm going to pay you 2% on your money. But at the end of 10 years, if that's what the maturity is, I'm going to give you your $1,000 back. So you know what you have. So anytime if you held it for that full 10 years, you're going to get your money back unless they go out of business.
Right.
The problem with a mutual fund that bonds, you don't know that because other people are buying and selling the mutual fund. So sometimes they have to liquidate those bonds, prematurely in order to get enough cash to pay out their different clients. So, again, we do individual bonds more so than bond funds. We'll do short-term bond funds if we see where we just need something to hold cash for a while, but not really long-term bond funds. The other thing you talked about was ETFs and mutual funds, equity.
Can you explain what an ETF is for some of our listeners that may not be familiar?
Sure. An ETF is called an exchange-traded fund, meaning that it goes in and you might buy when you go into it, they're going to buy the entire S&P index, meaning that all 500 of those stocks on that index are part of that fund. So no one's managing it. As long as that fund is on the index, then you own it. So typically the costs are a little bit lower, but you're not really hiring a professional to pick and choose what should be in that. So that's why they're a little bit cheaper. And really in the last 15, 20 years, they've performed extremely well, some of those ETFs. The other way, though, is a mutual fund where you find a manager who's been around a long time and has weathered many storms, and you buy that fund. And those funds can be, same thing with ETFs, can be all of them, be large cap, they can be very small companies, they can be high risk companies, they can be foreign companies. You can find a mutual fund or an ETF almost to buy anything you want. Another big one that's been really touted here lately is gold ETFs or gold funds, thinking that gold is kind of a way to work against the market.
What do you think about that, about the idea of gold as an investment during these times?
I'm not a big fan of it. I think that you can find people for and against. I think it was big when gold was part of the monetary system and actually meant something. But to me today, and again, I'm not a big an investor type person, and I'm not an analyst, but to me today, it's more of a precious metal, and it just depends on what people are thinking at that time. I think it moves kind of with the market, looks like to me. I'm not a big gold person, and most people that buy gold buy the metal itself and hold it as opposed to a fund.
It has some logistical challenges too, and I'd heard and read from a number of authorities in the area of like alternative investments and commodities and whatnot, is that there's a lot of paper floating around that calls for delivery at some point. That's the way apparently many ETFs buy gold, is that they don't buy physical gold, so that if anybody hangs on to this and actually expects delivery as the contract says you can expect, that there's not enough physical gold to support all this paper floating around, and that many people who think they're invested in actual gold, they've technically bought this paper, and the paper promises that they can have delivery of gold at some point in the future, but in reality, there's far more paper than there is gold.
I agree with that 100%.
Yeah, so why don't we do this? I thought we'd take a quick break and then come back and continue our discussion about suggestions from our financial expert, Todd Edkin with Baird, for people who are over 65 and, of course, dealing with the uncertainty of this coronavirus threat. Back in a few moments with ElderTalk.
You're listening to ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Sponsored by TuckerAllen, your estate and elder law advisors. And now, Attorney-CPA Joe Cordell.
We're back with ElderTalk, and with us today, Todd Edkin. He's a certified financial planner, financial advisor. He's with Baird. Many people have heard of Baird Financial. Is it Baird Financial?
It's R.W. Baird, Robert W. Baird.
Yeah, it's a national financial advisory firm, financial management firm. So, Todd, we talked a few moments before we went into the break. We had talked a little bit about 401ks. We had talked a little bit about IRAs, and we had talked about some of the investment opportunities that are out there. So when you look now, going back to this particular time and these particular conditions, important steps that people can make. Tell us some things that you call to your clients' attention that we've not talked about today.
Okay. Let's talk a little bit about all those people, which there are millions of people who never got laid off, who are still working. Their income is exactly the same. And those people who are, have first of all, they must have pretty decent jobs, or they certainly are necessary.
Well, they're not in one of those industries like hospitality or airline.
No,
probably.
they're not. So one idea that we came up with at the very beginning of this, especially when the market took that big plunge, for some people who actually had enough cash saved up where they could support themselves for several months, we suggested they increase their contribution to their 401k plan, thinking that it'd be better to invest while the market was down. So, most people will go in and they'll say, okay, put 10% of my pay into my 401k plan, and they do that all year round. So in a down market, you can go back in and say, hey, put 80% of my pay for this next 2 months into my 401k plan. Now, again, you have to live on savings for those 2 months, but it allows you to get your money to work at a discount as opposed to, dollar cost averaging in for the full year.
And you said only 2 months you would do this, you would recommend?
I would recommend until you get to the point that you would have funded it for the whole year. So, $19,000, if you're under age 50, is the maximum you can put in the 401k plan. So if you normally put in the full 19,000, I would do 80% till you got your full 19,000 in it.
That's an interesting idea. So just so people are getting this, the 19,000 still applies. So whenever Todd, you're saying for them to increase it to maybe 50% of their net pay potentially, depending on what that is, that you're not saying that they're somehow get to avoid this 19,000 limit for the year. You're just saying go ahead and pack it in now when the prices are really low, so that it's okay that they won't be able to put in any more for the rest of the year probably.
That's correct. And then they can build up their cash once, they've got it all in there, and then they're getting a little extra in their paycheck at every week or every couple of weeks, and they could save that to build up their cash position again. That way, they're just getting it in a very low price compared to what they might be getting in. Who knows? In December, we might be back to the record highs again, but then you'd be buying at a higher rate.
Yeah, it's just really it's difficult to know where this bottom is. So, what other suggestions do you? Whenever you have clients that are in this situation and maybe they're risk averse, do you have some people who are saying, look, I just want my money in cash on a shelf? And I know that you try to resist those panicked clients who call you and say, dump everything, get me out yesterday. You try to talk them off the ledge. But there is that rational response that says maybe we should just be sitting on the sidelines now. But that means liquidating your position at a big loss for most people, right?
Yeah, and I would not be earning my fee if I allowed, I can't say allowed, if I didn't advise against that. Because historically, through the biggest crises we've ever had in in the history of these countries, and we've had a bunch of them. We've had wars, we've had big tornadoes, but our market always comes back. It always comes back. Then we had the Great Depression. It comes back. Everything's going to come back. And I'm just an optimist about that. I just believe in the American people, and I believe in our economy. And people are going to figure out a way to make money. That's just all there is going to be to do it. So I really discourage people to do that. And if they really want to do that, then I would have been talking to them that before this down market and said, hey, you got too much in equities. You should have more in cash. That way they don't get so afraid when the market does go down.
And Todd, what do you think you've learned from a financial standpoint from this pandemic and how this may help you if we have, God forbid, another pandemic of this sort?
Yeah, as I said earlier, Americans have a short memory and financial advisors have a short memory also. So in 2008, we learned this, and again, I learned it again today, is that just because you talk to a client in good times and we're talking about their risk tolerance and how much they'd really worry about if the market went down, their response then is not going to be the response when things go down. So I've learned, again, as I did in 2008, that I can't just sit on that answer for the rest of their career with me. I need to every year go back to them and say, hey, let's rethink this. What would happen if the market would go down now? What should be investing in to make sure that you're not going to jump off the ledge if things go down. So we need to be adjusting our portfolios accordingly especially as they get older. We do that anyway, but just according to their risk tolerance as their life changes. So we need to have that conversation more often.
So, and you also, as a financial advisor, talk to people about their budgets. And we talked about how credit card debt can be a problem. Some people are doing some discretionary spending now that perhaps they wouldn't otherwise. But whenever you have someone who has finite resources, they are retired, and they're discussing with you how they are to get by, what do you say to the people, though, who have less income because of these changes that we've already talked about? I mean, there's a limited number of places they can go get more money, and then they have to start looking at lifestyle decisions. Do you participate with them in thinking about what is it that we can cut in terms of our standard of living, and what are the strategies that people sometimes follow in that situation when they're already retired and maybe not employed even part-time?
Yeah. So I have that conversation with all of our clients, on a continuous basis. And what I have learned is that in America, you can live very cheaply and not starve to death with nothing. I mean, I see it happen every day out on our streets. So worst case scenario, you might not have a big house, but you're still going to have a roof over your head. You probably have a car, and you're going to have food. The second thing I tell people is, and again, I'm a no debt type person, and I know some people think, hey, it's cheap money, borrow the money, you can earn it back in the market. But I'm more, if you have a mortgage going into retirement, that challenges a little bit of your stress-free retirement because you have that mortgage payment. If you don't have that mortgage payment, you can live very, very cheaply. Thirdly is when we're talking about what are necessities, people look at those things differently. Cable for some people is a necessity. To me, that's the first thing I would cut out. And other things that you have these minor changes, you can reduce your expenses tremendously. And a lot of our clients have witnessed that just for the fact that they haven't been able to go out to eat every single night in their credit cards. And I've heard this many times from just talking to my clients over this last 3 or 4 weeks, is their credit card bill has been so much smaller because, again, they're having to eat at home. Right. So you can do it. There's nobody that can't make this work.
Mm-hmm. And when you think about the fact that you probably aren't going to be doing any traveling for a while, so that expense has gone away.
No summer vacations
And gasoline is dirt cheap, and you're not even driving.
$1.49 I just paid today.
I know it. So there's a lot of benefits, that's for sure.
I know that there are people who might have had plans to sell their house going into this, maybe perhaps in December, January, even February. Other people that were thinking about buying a house or even buying a condo, and now suddenly they're wondering, do we plan on simply hanging out where we are now indefinitely? Do you have any sense for what's going to happen in the real estate market?
Yeah. Well, again, we just have historically low interest rates in order to get loans. But I think you're going to see where banks are going to start being a little more selective of who they're going to lend to, because I'm sure that we're going to have some bankruptcies going into this, and people aren't going to be able to pay their notes. So I think they're going to be a little more selective. I don't know that for sure, but I kind of predict that. But I think on the real estate front, if you're selling a house and you use that money to buy a new house, I don't think that changes a lot. If you're going into a bigger house and you may have a bigger loan payment, I think you need to really look at how secure your job is going to be, not just for, you're working today, but is that industry still going to be viable where it's going to keep you employed 6 months, 2 months, 3, 4 years from now? Because you're going to need to make that mortgage payment. But again, I think these lenders are going to be a little more selective.
And of course, some people are going to be wanting to downsize, though. I mean, people who they're in larger places and they want to move into perhaps a condo, in some cases something like an assisted living facility or independent living, and their plans had been to sell, and now they're wondering, gee, how do I sell now without this big loss? And I think for many of those people, they're going to just find maybe for the next several months that they need to stay where they are. Any comments or thoughts on that?
Well, right now, though, the real estate prices have held up pretty well, at least in Louisville, Kentucky. In southern Indiana, where I live, the prices have not decreased. The buyers, there's still buyers out there and there's still sellers out there. So I haven't seen where that's going to be an issue, but down the road it might be. But if it is, you just kind of hang on until it comes back up.
And Todd, what's your advice about other large purchases, say cars? I know I've been watching so many car commercials where they're offering all these incentives to get you to buy, and it is very attractive. No payment until December. What do you think about that?
Even discounts.
Yeah.
I think it's a great opportunity for people who know that their job is going to be secure. Surprisingly, 6 months ago, I would have never, ever suggested people buy a leased car. And I had one of my retired clients talking about, buying a new car, and she wanted a new car every 3 years. And when I did the numbers, it was about a $4,000 difference of what the lease would have been as far as the depreciation of the car over that 3 or 4 year period. And it really, for her, because she wanted that new car every 3 years, it was a better choice to lease the car. Because every 3 years she gets a new car. She doesn't have to worry about selling it. She doesn't have to worry about the upkeep and things like that. But that's a whole different conversation. But it was something that made, open my eyes that sometimes a lease is not a bad choice.
And that's one of the services, though, that people who have a good financial planner can expect, is somebody to help them make decisions like that.
Right.
Yeah.
We've covered a lot of territory now. So one thing I wanted to mention, though, is those who are fans of Todd, who've listened to the show and heard Todd on several times, I just want you to know that he does do financial management and financial planning. He is based in Louisville, which makes no difference because, you still have a relationship these days without being across the desk. But anyway, Todd, I just wanted to mention that for those people who perhaps wanted to talk to a certified financial planner. The point is, Todd, this is a time when more than perhaps any other, people are going to be turning to financial planners to admit the fact that this is a situation where it's unknown territory. We don't know whether to go left, right, or forward, and they're going to want professional advice. So it's good that there is that service out there. Too few people use it. We've talked a lot about that. I'm a big fan of financial planning, and you and I have, of course, no financial relationship. I mean, this is strictly something. Whenever I say that Todd is somebody I recommend, he doesn't pay to sponsor this show. We don't do that on this show. We're proud of the fact that anybody we have on this show, anybody you listen to as a guest on here,
right,
is somebody that we individually believe in and have confidence in. We don't sell products, and people don't sponsor this show and as a result get on here. These are people that we have confidence in. So anyway, I'm just throwing that in, Todd, for those that might have an interest.
I appreciate that. And it's always a pleasure being on. And, again, going back to what financial planners do, the biggest thing we do is manage emotions. And during this time is where we actually earn our money. Yeah,
I would say so. And this is your time of greater stress, perhaps, than when you're at 30,000 on the Dow.
And that for sure.
So anyway, I appreciate your being on. I'm sure we'll ask you to come on again. Take care.
All right, guys. Have a great day. See ya.
All right, goodbye. Another episode of Elder Talk. Till next week, take care.
You've been listening to Elder Talk with TuckerAllen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of Elder Talk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.